Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Higher rates sends investors heading for the exits. So interest rates have been rising for the better part of the last 18 months, but longer-term interest rates took another leg higher this past week to levels not seen in more than 15 years. The benchmark 10-year U.S. Treasury rate went over 4.6% after being as low as 3.3% just 5 months ago. That is a huge move in a short period of time. Now, higher interest rates are putting pressure on stock valuations. The S&P 500 index has now fallen more than 5% in just the past 2 weeks. And while overall the stock market is still showing decent returns year to date, there's a lot of damage under the surface. 5 out of the 11 S&P sectors have negative year-to-date returns, and 8 out of the 11 sectors have year-to-date returns of less than 3%. Meanwhile, the equal weight S&P is roughly flat on the year, which means the average stock has really just been stuck in the mud at best. So buckle up for a bumpy ride because things might get a little worse before they get better. For this week's featured insight, credit tells a story. So if you want to be a sophisticated investor, you better be paying attention to the credit market. What is the credit market, you ask? Well, it's basically the market for borrowing. And in the corporate world, that means the bond market. Companies go to the bond market to borrow money. And with interest rates rising in a heavily indebted economy, you're beginning to see a lot of weakness in companies that may have bitten off a little more than they can chew. If you're wondering why a stock you bought is underperforming the market, it could be due to the fact that that company has poor credit. In other words, they have too much debt and could have trouble repaying. In a stagflationary world, that is a stagnant economy with higher than normal rates of inflation, companies with debt problems are especially vulnerable. Instead, you should be looking for companies with low debt and little need for external capital in order to finance their operations. Looking ahead, October buying opportunity? Well, October is famous for market crashes, but a lot of the pullbacks that have occurred in the seasonally weak August and September months have created buying opportunities into what is typically the strongest time of year for the stock market. That is November through May. And despite the potential for further downside, longer-term investors could have an opportunity to do some dollar cost averaging into stocks over the coming weeks. That is, buy an equal amount at regular intervals over a predetermined time frame. Now, don't worry about trying to catch a market bottom. Stocks are down 6% in the past 2 months and are still 8% below their 2022 peak. That doesn't necessarily mean that they can't go lower, but 5 years from now, you'll likely be happy with your decision to do some buying during periods of market volatility. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.